Hey everyone, and thanks for jumping back into the Macroverse. Today, we're going to talk about the Treasury yield curve and how it can be useful in understanding the health of the US economy. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and check out Into the Cryptoverse Premium at intothecryptoverse.com. We do have several different tiers available. Make sure you check that out, including a free one. Let's go ahead and jump in. So the last time that we talked about the Treasury yield curve, or at least I should say the last time we did a full dedicated video on it, was I believe about 3 months ago. Now we have spoken about it since then, of course. We talk about it somewhat frequently in the context of other macro indicators that we're looking at, and so we will frequently bring it up. But the last time we did, I believe, a full dedicated video on it was about 3 months ago. And you can see here, right, it was sometime in mid-October. So the reason why I want to provide an update is because it's already starting to look quite a bit different today than it did back then. All right. So today you'll notice that the short end of the curve has risen a lot relative to the long end of the curve. So, back in October, the 1 month was well below, the 3 year and the 5 year and the 7, and so on and so forth. And so too was, the 3 month, and the 2 month, etc. Only a few of these ones, say like the 6 month and the 1 year, were more elevated than some of the longer term ones. So today, though, you see it is a bit different. What do you notice about it today? The short end of the curve is actually much higher than the long end of the curve, right? So the short end of the curve is much more dependent on, what the Federal Reserve is doing here in the short term, right? So, if the Fed funds rate is around 4.5%, then you're going to see the short end of the curve somewhere around that level because, it's not that hard to imagine what their policy is going to be a few months from now. Whereas 5 years from now or 10 years from now is obviously a different story, right? There's going to be a lot more complexity related to that. Now, what you'll notice is that, again, the short end of the curve is almost fully inverted now, right? I mean, you're looking at an almost fully inverted yield curve, and all you'd really need to see is for the short end over here, the 1 month, the 2 month, and the 3 month to rise above the 6 month. You're essentially looking at a fully inverted yield curve, with the exception of maybe the 20 and 30 year here at the very end. But the reason why this is important is if you think about this from a fundamental perspective, right? If you're putting your money in a bank and say like a CD or something, you're locking it up for a while, you would expect, in general, right, if the economy is healthy, you would expect to get a higher yield for holding it in that account for longer periods of time, right? At least when you, APY, right, when you annualize it. So you would expect that, if you're going to put your money in a bank and you're going to leave it there for 3 years, it would make sense that you would get more annualized than you would if you were only doing it for 3 months, right? It makes sense. You're essentially taking on more risk by locking it up for a longer period of time because you're missing out on potential other opportunities that the market might offer. But when you see an inverted yield curve like this, it historically has been a fairly good predictor of, or at least saying, the economy is somewhat sick and it's going to take a while for it to get better. So what I want to do here to begin with is I'm going to play the evolution of the yield curve starting from the 1990s. Okay, so we're just going to hit play. And what you'll see is, here, this is what it normally looks like, right? You would normally expect to see like this. Now we're coming up on the 2001 recession. So look what happened, right? It inverted. Now we're coming up on the 2007 recession, right? The financial crisis, right? The inversion, and then you come out of it. And then this is what it looked like during basically a decade of economic expansion. Fairly normal yield curve. Coming up on the 2020 recession, very brief. You can see it it briefly inverted. And then now this is where we are again. So scroll it back through time, right? If you look just before the financial crisis, you'll see that it was inverted. You look back to this is the .com crash, right? You look back to the financial crisis, you'll see the inversion of the yield curve, right? Same thing, right, with what happened in 2020, at least to some extent. I mean, that was sort of a crazy time because everything happened so quickly, right? And so it took a lot. Everything was sort of adjusting quite quickly because policy was kind of all over the place and was a lot of uncertainty at the time. But look at it where it is today, right? So what does this mean? And one of the things that we've talked about before is that the inversion of the yield curve does not mean you're in a recession, right? It does not mean that, and historically has not meant that, right? You take a look at Treasury yield spreads. When the yield curve inverts, right, or at least if you say look at the spread on the 10-year and the 3-month, when it inverts, are you in a recession? Typically, no, you're not, right? Plenty of times where when it inverts, we don't find ourselves in a recession. So the inversion of the yield curve in and of itself is not a predictor of a recession, or it's not a predictor that we're in a recession. It's a predictor that by the time it all resolves itself, we'll likely find ourselves in one, right? But here's the problem. Like, here's the thing that I think a lot of people need to remember about this is that it can take a long time, right? It can take a long time to actually see it fully play out. And if you looked at the spread on the 2-year and the 10-year, the average lag, I think, on it from a sustained inversion, so let's say for 3 months or so, is like almost it's like 17 months, I think, right? Or something like that. Around a year and a half. The average time. Now, you could find periods that are less than that, right? And you can find periods that are longer than that. But on average, it takes about 17 months or so from the sustained inversion of the yield curve, and let's call sustained inversion about 3 months being inverted from that point, before you actually find yourself in a recession. So that means that if the United States experiences a recession, it might not be until another half year or another year potentially, right? Now, I mean, of course, it could come at any time, but that's the thing that you have to remember, and that's one of the reasons why the yield curve is an important tool, I think, to sort of show you where the healthy of the economy is, but it's not necessarily the most helpful tool in telling you, exactly when the recession is going to come. It tells you that one is likely coming at some point in the nebulous future, but again, a lot can happen in markets between now and then, right? And this is something we talked about for a while, is how the lag time on some of these indicators can be a year and a half, sometimes even longer. Okay, I mean, there's been periods where it can take, over 2 years before you actually get something like that. So that is something that you have to keep in mind. Now, when you look at the 3-month and the 10-year, this is a question I've been getting quite frequently, so I wanted to address it. A lot of people have looked at this and said, well, this seems somewhat crazy. The Treasury yield spread here is deeper inverted than it, at least than it has been, at least the data we have on the website. I mean, going all the way back to the 1980s, it's more inverted than any time in the last 40 years. Okay, so what does that mean? Well, in what I've looked at, there really is not a correlation between the depth of the inversion and how bad the recession will be. So, and that might come as a surprise to some people, right? You might look at this and say, well, the deeper the inversion, the worse it has to be. That's not actually true, okay? If you look back throughout all of history, there's not really a clear correlation that I could find between the inversion, the depth at which it inverts versus the severity of the recession, okay? So again, this might come as a surprise, but if you're looking at this and you see it, and you see it all the way down here, at negative 1.24% versus where it was back, say, before the financial crisis, you might look at that and say, wow, it's like twice as bad. Does not mean the same thing. Like, it does not mean it's going to have to be twice as bad, right? It simply does not mean that, looking back throughout time. So I would say, again, when it resolves to the upside, whenever that occurs, whether it's next quarter, 2 quarters from now, the end of the year, next year, it typically means you get a recession, but it does not mean you're in one typically during the at least the initial phase of the inversion, right? Going into the inversion of the yield curve, you really don't find yourself in a recession. In fact, if you look closely, what you'll notice is that typically when it inverts, the market can still go higher and put in new highs. This is not that uncommon for the market to do. I mean, look what happened over here when it inverted, back in July of '06. It did not stop the market from rallying for another year or more before it finally came out of it and we experienced the recession. Now, what is interesting about this time versus the other times, right? And at the risk of saying something is different, right, and the sort of the cliche that has become, one thing that I do think is at least worthwhile to point out is the interest rate hikes and the speed of them. Okay, so if you were to go take a look at the effective federal funds rate, what you'll notice, and if you really hone in here to the last like 30 years or so, normally the Fed is raising interest rates when the market is pretty strong and moving along pretty well, not really during periods of high inflation, right? Where this was not during a period of high inflation, and the 90s was not really during a period of high inflation. Again, the interest rate, the effective federal funds rate was going up over here in 2000 and like 99 and 2000. The market was still pressing to new highs, and then once the market rolled over, that was when the Fed cut. Okay, raising interest rates quickly over here in 2004, 2005, 2006, and then a pause throughout a lot of 2007, and then the minute the market, the minute the economy showed weakness, the Fed caved, and then they quickly cut, right? So what's going on this time? And maybe one more comparison is going into what happened in we saw rising interest rates in 2016, 2017, 2018, 2019. Again, during a period when the economy was pretty strong, market was going higher, and then they quickly cut, right? Very, very quickly as the economy started to show signs of weakness. So then what's going on today, right? I mean, it looks very dissimilar from at least the last few, right? This time, the Fed is raising rates and the market is going down, right? So, I mean, it is very different from what we saw during the previous rate hikes because, at least during the last 3 rate hiking cycles by the Federal Reserve, the market was trending higher, not lower. Again, why are they doing this? Well, again, we know why. It's because inflation's high. So they feel compelled to, to be hawkish, even despite the fact that the economy is saying, hey, things kind of are not so great. Why are you doing this? Well, the Fed's saying, well, we have to. Inflation's high. It's part of our mandate. So this is an important nuance, I think, of this cycle is the Fed, and this kind of goes back to 2022 when you essentially had effectively everyone collectively saying that the Fed will never go above 3.5%, or they'll never go above a couple percent, or people saying they'll never raise by more than 25 basis points. And the reason they said that is I mean, it's not that absurd, I think, for them to have said it. It's just that everything that they've probably known for the last 10 or 20 years has been that, right? It's always been, well, the Fed's only going to raise by very small amounts, and the minute everything starts to look bad, they're going to cut. Why did a lot of people think that last year? Because that's what they always did, right? That's what the Fed always did. But again, in order to understand what the Fed does, you have to look at similar periods, right? And to find a similar period as to what we're going through today, at least you'd have to go back to the 1970s, right? Find a period of high inflation, or the early 1980s. You'd at least have to look back then where the Fed was much more aggressive with interest rate hikes than they ever were in the last 20 to 30 years. So, it's a mistake to look back at the last few business cycles and say, well, because the Fed did this during those times, it means they're going to do it this time. You have to look for similar conditions, right? And similar conditions involve, looking at things like periods of high inflation. Okay. So then going back to the yield curve, right? So going back to the yield curve, it's almost fully inverted. Once it uninverts, that's when the recession typically comes, right? Look at the Treasury yield spreads again on the 3-month and the 10-year. It's when it uninverts that it occurs. It's nowhere close to uninverting right now, right? So again, historically, what this indicator shows is that it's not a predictor that we're in a recession during the inversion part, right? It's not. It's a predictor that one will likely occur at some point before this, before this cycle is all done with and we start a new one, right? Before we get into another phase of true economic expansion, you will probably need to see the resolution of this. And when you get that resolution, I mean, what it has historically meant is a recession. It can be a very short one, it can be shallow, it can be deep, a long recession. It all depends on how much damage the Federal Reserve does to the economy, not only via higher interest rates, but also through quantitative tightening, like rolling off assets from the balance sheet and draining liquidity from the system, right? So you first start off with essentially a liquidity crisis. I mean, it's basically what it is, right? I mean, it's what we had in 2022 where they're just draining liquidity. So you have like a liquidity crisis where it's like, well, hey, where's all the liquidity? Why is the liquidity going away? Well, money's not as cheap as it once was because interest rates are higher, right? And I mean, the Fed also seems pretty determined to make the unemployment rate go up. So I mean, that's just going to create a lot of hardships for people, and if that's the case, it's usually not that kind to equities as we've seen in the past. So I would keep a close eye on this on the yield curve, and again, just to remind you, the depth of the inversion is not necessarily indicative of how severe the recession has to be. Okay, it's not. And again, the 2-year and the 10-year is actually not as inverted compared to where it was actually in the 1980s. I mean, you can see it had pretty deep inversions back over here. If you look at the 3-month and the 10-year, going back to at least what I have data for here on the website, you can see that it's more inverted than it has been at least since 1982. Why is it more inverted this time? Because this rate hiking cycle by the Fed is essentially like nothing we've ever seen. I mean, the pace at which they've gone is not something that is very common. And so I mean that's one of the reasons I think you see it like this. And what's also interesting is how a lot of market participants throughout 2022 just simply did not believe the Fed that they were going to actually raise rates this much. And arguably, I do think that investors are more aligned with what the Fed's actually going to do. But there are a lot of investors that that are pricing in cuts by the Federal Reserve this year. And while it could happen, I think the earliest it could happen would be the end of this year. And there's actually a high chance that they don't cut until next year. I mean, they've been fairly clear about that. And I know a lot of people say, well, why should you trust what they say? I mean, if you trusted what they said last year in 2022, you would have just been risk off, right? And cash is king and all this sort of stuff, right? Because, hey, if they're going to keep raising by 75 basis points and get us to a pretty high terminal rate, that's just the harsh reality of a hawkish Federal Reserve. So again, fighting the Fed last year, it did not work, right? It did not work at all. And so we have to keep that in mind. So again, just to sort of finalize here, looking at the Treasury yield curve, it's almost fully inverted. And I just want to, again, draw your attention to what it looked like the last time we did a dedicated video on it. You can see where it was and how quickly, just over the span of the last 3 months, how quickly the short end of the curve is now all the way up here with respect to the long end of the curve, okay? And so at some point this will resolve, but I want to remind people, it can take another 3 months, it could take 6 months, it could take a year. So again, you need to remember that as an investor, that just because it looks like something's going to happen does not mean it has to happen tomorrow. And as we have seen, the US economy has not wanted to go down without a fight. I mean, look at the unemployment rate. It still is at a secular low at 3.5%. That's the lowest it's been this business cycle. I mean, you can see that's where it was in July of 22 and also in September of 22. The US economy is clearly not going down without a fight, but the Federal Reserve also seems determined to make this eventually go higher above the, well above the, or at least somewhat above the 4% level. So this is something we need to continue to watch. If they are successful in raising the unemployment rate, you can see that does tend to correspond to recessions. And once you see a once you see that happen, what really will be interesting is the response by the Federal Reserve. Because so here's the thing that you have to think about, like, as an investor. You have two different things that the Fed's dealing with, right? You have period of high inflation, which is coming down quickly, which is a good thing, but you also have the unemployment rate, which hasn't really budged. So here's the potential issue. What does the Fed do if the unemployment rate starts going up and inflation is still at 4 or 5%, right? What do? I think the market would expect them to go back to QE, right? And it's almost like the market is thinking that they'll just start cutting rates immediately whenever that happens. I also think there's some evidence, if you listen to what Powell says, that they're really not going to go back to that until after they really see a sustained path back to 2%. I don't even think getting inflation back down to 4 or 5%. Core, if it's core, it could be less. But if it's at 3% or 4%, they still might want to see it go lower before they're willing to actually change their policy in any substantial manner. So again, that's something to think about. The most ideal scenario, of course, would just be that, at least for the U.S. economy, the most ideal scenario would be that the Federal Reserve is able to accomplish their mission of reducing inflation back down to their 2% target without affecting the unemployment rate in a material way. We are starting to see, and we have been seeing for quite some time now, the tech sector. We've seen pretty substantial layoffs, right? And we've seen 6,000 people laid off at company A, and then 12,000 at company B. Again, in the grand scheme of things, it's still a relatively small amount of people within the context of the entire United States workforce. But tech is going to get hit first, right? I mean, this is one of the first things that's going to get hit. Why? Because growth, like the tech industry, so like growth companies, the way they grow so quickly is because they have access to cheap capital, right? And so by taking on that debt, they can really start to try to grow quickly. When interest rates go up, the cash isn't as cheap, so they're not going to take on as much debt. They're not going to grow as quickly. And so because of that, what's one of the ways that you reduce your costs as a tech company? What's one of the quickest ways is just to lay people off, because you're instantly not having to spend that money on those employees anymore. I mean, I get it's a brutal cycle, but that's what happens. And so the argument, of course, is that if the Fed continues to do what they're doing, which it seems like it's likely what they're going to do, eventually this effect will filter through to other sectors. And then when it does, the unemployment rate will go up, and then it will help reduce wage inflation, which is what the Fed is keeping an eye on. And that will help CPI get back down to 2%, hopefully in a sustained way. And once that occurs, we can ideally go back into a period of economic expansion, right? That's the idea. Do we get a recession between now and then? That's up for you to decide, right? There's a lot of charts that suggest it's going to happen. With that said, there are a few macro charts that still look pretty strong. And again, the unemployment rate is one of them. There's still a few charts that say, you know what? We haven't really seen the U.S. economy scream that there's a lot of weakness here yet. And so, of course, there is still some hope that the United States will avoid a recession. But that's what we're currently looking at. Hopefully, talking about the yield curve, at least every 3 months or so, a video on it is helpful to people. I do understand that this content is not as exciting as some of the content I could make, but I would be remiss if we didn't spend time talking about this. Because see, here's the thing, right? Like, a lot of people would like for this thing to just get resolved and for us to not go into a recession. And while that is always a possibility, right? Certainly anything's a possibility. The problem is that it is really ignoring history, right? It really would be ignoring history to say that it won't happen. And so I do think we need to be aware of that. And the reason we all need to be aware of as investors is because, typically equities bottom during the recession, right? I mean, that's where we've historically seen the S&P 500 bottom, right? It doesn't bottom before it. It bottoms during the recession, right? Historically, or after, right? I mean, I think if you look at like the last 10 recessions that we looked at, all of them bottomed during the recession, except for this one over here in 2000, which bottomed after it. So that's what history tells us. That's why we follow it. Could take 6 months, 12 months to play out. Who really knows? but we will follow it every few months and probably maybe just provide an update on the yield curve once a quarter, right? Like a dedicated video on the yield curve once a quarter will help keep us aware of what's actually going on here and what is it telling us about the health of the US economy. If you guys like the content, make sure you subscribe, give the video a thumbs up. And again, we do have Into the Cryptoverse Premium at intothecryptoverse.com. See you guys next time. Bye.